I know you said it's not QE, but it's $390 billion over 5 months, which is a lot to expand the balance sheet. I guess I'd ask one more time on Nick's question, is there a number that you have in mind? Secondly, a lot of people in the market are sort of concerned that it looks like QE and they're trading that way. Are you concerned that the market is embracing this like a QE program and that the rise in the stock market is linked to it, and you may then experience something of a taper tantrum the way Chairman Bernanke did when he tried to roll it off?
So I'll just I'll repeat that we think that we need to continue purchases until reserves are at a level at which they will not go below $1.5 trillion roughly during the course of the calendar year, and we know that the TGA will move up and down that. So they'll be much higher than that sometime. But that's kind of the number, and we think we'll reach that sometime in the second quarter. That's our estimate, but we'll know it when we get there. We'll know it because we'll be able to control the federal funds rate without active use, ongoing use of open market operations. You know, our intention of for these adjustments is just to raise the level of reserves and to allow us to conduct monetary policy in an efficient and effective manner, and that is our sole intention. I pointed out on other occasions more than once the differences, the really specific differences between this and the large-scale asset purchase programs. We've been over that. In terms of what affects markets, you know, I think many things affect markets. It's very hard to say with any precision at any time what is affecting markets. What I can tell you is that you know what our intention is. It is to return reserves to an ample level. We expect that to happen during the second quarter. And our plan as we do that is as those purchases get to that level, we believe we can gradually reduce them, and we believe we can also gradually reduce repo as we reach an ample level, as we're satisfying demand now more from underlying reserves from bill purchases rather than from repo. And again, last thing I'll say is we're prepared to adjust the details of this plan as we've shown ourselves willing to do, depending on conditions.
Hi, Chair Powell. Gina Smilek from the New York Times. I was hoping that you could talk a little bit about the labor market. We've recently seen wages moderating a little bit by some measures, maybe even declining a little bit by others. As you mentioned, at the lower end of the sort of talent pool, it seems like we are seeing those wages climb up a little bit, but it doesn't seem to be consistent across the entire sort of average. I was wondering if you talk a little bit about whether you guys are noticing any cracks or whether you're worried about that or how you're thinking about it.
The labor market continues to perform well. The labor market continues to be strong. We see strong job creation. We see low unemployment. Very importantly, we see labor force participation continuing to move up, really against expectations. If you go back a few years, you will not find a lot of forecasts suggesting that we could have been at 63.2% overall labor force participation or the levels of employment to population that we're seeing now, let alone the unemployment level. So I think we've learned quite a lot of good things about the labor market, good things suggesting that there's been more room to run. The performance of wages, I think, has to be seen in that context. We saw, if you go back 4 or 5 years, the 4 or 5 major wage statistics that we track were running at around 2%, and now they're running at around 3%, which is theoretically about where they might be at full employment. It would consist of inflation plus productivity growth. It's a bit surprising that with sustained levels of historically low unemployment, we haven't seen wages moving up above that level, as we have in other long expansions and other periods of low unemployment. So you ask what can be explaining that? You know, one thing can be that the natural rate of unemployment is still lower than we think, that the labor market is not as tight as it would appear just from the 3.5% number. And the other can be, I think, that, as I mentioned, the sort of supply side shock or surprise that we're receiving from higher labor force participation. People are coming into the labor market and providing more labor supply, and that's a great thing. That's a very healthy thing. We're a country that has low labor force participation compared to essentially all of our advanced economy peers, and it's a very good, positive thing. Nonetheless, it represents more labor supply, and it may be holding down wages.